the banks have two issues. They have the legal issue that you've been reading about in the paper. They don't have the paperwork correct. Nobody knows who owns the loan. I actually wrote something about this using my mortgage. My mortgage was originated by a bank in New York. They sold it to Lehman Brothers 7 years ago. Nobody ever changed the title in the courthouse. It still says Bank of New York. So legally, Lehman Brothers can't do anything. The trustee in the Lehman Brothers bankruptcy can't really do anything because they don't have a lien on my house, legally. So that's part of the issue. But I think the reason you've seen moratoriums on foreclosures is just because they can't do anymore. The banking industry is trying to stretch this process out over years. And the problem is when we muddle along, which is essentially how I would characterize the Obama administration, you end up with no credit, with banks that are shrinking, and an economy that's shrinking. So that's really the cost. I feel that this is really going to overwhelm some of the biggest banks, especially Bank of America and Wells Fargo. They just have so much exposure, and they have to take physical possession of foreclosed homes. We're essentially turning these banks into real estate investment trusts. And they don't have the income, they don't have the people and the infrastructure to deal with this. My firm's actually done some work in this area, so I know what the costs are. And I think that we have to address this whole problem as restructuring. And that may include using the Dodd-Frank law and the authority that we have in the law to go and restructure some of these big banks 3 years later. What I think is going to happen in the next year is a continuation of the crisis. We bought a year. If you think of 2009 as the year that wasn't, it was kind of an interregnum between the market crisis and where we are today. I think the reality of the real estate bubble bursting is going to really come home next year. If you think of it this way, the U.S. banking industry has about $1 trillion in tangible equity. If you put aside all of the fluff and the intangibles that are on their balance sheet and just look at cash equity, the losses from what I'm describing could be a couple times that. So what we're talking about is the federal government having to get involved in the way that they did in the 30s, create vehicles for liquidating these assets. And you got to remember that the banks, Fannie, Freddie, are now the biggest sellers of real estate in the United States, what we call involuntary sales from foreclosure. That's a bad indicator. But I think that's only going to continue. So I'm hoping to try and change expectations a little bit and just make people think. Another thing that's very important is the Fed and the fact that they're keeping rates low and they say they're trying to help us. But it was interesting because what I was trying to focus everyone on is that the banks are keeping all that money. They're not passing that on to households, refinancing their mortgages, that sort of thing. So there's no benefit for households right now. And people read in the paper, well, you know, the Fed's keeping rates low, they're going to go buy more government bonds and everything else. But it's not trickling down. And that's the big difference between this recession and all of the other recessions that we've had really since World War I. I get into this in my book, by the way. It's going to be out in December. It's called Inflated: How Money and Debt Built the American Dream. And we're kind of at the last leg. After the war, we still had the stimulus from war spending. Everything else was gigantic. And from about the 70s on, we used housing as the major driver in the U.S. economy. So the question now is, what do we do? What comes after housing? And my guess is, you know, we got to go back to basics.